And so everyone's always asking what's going on in the market, how to talk to clients right now. And Hugh has a brilliant brain with a strong economic background. And we're starting a new thing called Hugh Knows. And Hugh put together this awesome slide deck for us to talk through, understand some key data points, and have some takeaways. And we're going to put together a video like this often. So this is our first one. We'd love to hear your feedback, your comments, let us know how to improve, but we're going to take a shot at it and try to add some value and help you communicate to your buyers and sellers right now. So Hugh, how do you want to kick this off for everybody? Or Austin, you have anything to share?
Yeah, just real quick, this video is geared toward realtors. So if you're a realtor, this video is really primarily geared toward you guys. Of course, if you're not a realtor, we'd still love for you to watch it. I think it's got a lot of valuable data out there for anyone who's a homeowner and looking to become a homeowner. But our target audience for this video is specifically realtors. And what we're trying to do is we're looking at all of these data points that all of a sudden we've become very familiar with over the last year. You know, the Fed rate, you know, the federal funds interest rate, how does that impact mortgage rates? And we know that it does, and we know that whatever the mortgage rates are impacts what's going on the real estate side. And so what we're trying to do here is we're trying to just demystify some of these terms, help you guys understand these different things that are driving ultimately the mortgage rates, and then how that's going to impact the housing market. And so that's really the heartbeat behind this. And all of this data Hugh has pulled together. These are all different charts that he has made. And so we're looking at a bunch of different sources to grab the data. If you have any questions, we want to hear about it. And obviously, if there's any other data points that you'd like us to go into more detail on in the future, let us know. But without further ado, Hugh Knows, what is up?
Hey, thanks, Jonathan. Thanks, Austin. So I am going to first go through our agenda today, which the first thing that we're going to look at are interest rates and inflation data, specifically interest rates that are pertinent to the mortgage market. We'll then look at the most recent data on labor markets, both looking at the national level, but also looking at Houston as well. And then we're going to dig down into some Houston area housing sales, looking at Harris County specifically, so bringing it home to the market here in Houston. And then finally, we'll end on some outlook and some strategies. So let's jump into it. So the first thing that we're going to go through is to look at a couple of key interest rates and bond yields that are closely tied. So on display right here, I have three different data series: the 2-year U.S. Treasury yield, which is in the green area; the federal funds effective rate, which is the actual rate that the federal, the U.S. Fed is able to achieve; and then the target funds rate, the upper limit, which you can see in the dark blue triangle. So what you can see basically here is that the three data series are pretty highly correlated. They're pretty tightly on a 1-to-1 correlation, you might say. And the market is really looking at these interest rates pretty closely. The federal funds rate is the rate that the Fed sets when it meets at its meetings, and when you hear that interest rates have increased or decreased by the Fed, that's the rate that they're talking about. And then the 2-year U.S. Treasury yield is closely tied to that. So these are two interest rates that are very closely tied together, and they are impactful to the mortgage market, which we'll see in the next slide, in the next couple of slides.
Okay, so Hugh, so we're looking at this. The Fed is what everyone's paying attention to, right? What the Fed's doing, and we can see that, you know, starting back, you know, pre 2015, really, you know, everything's really low, and then it starts to rise. Obviously, we get up to 2019, late 2019, and then all of a sudden we get to 2020. They start to kind of level off, and then, man, that plummet. What's that plummet? Remind us.
So what we're seeing here is, what we're seeing here is the impact from COVID. So when COVID happened, we saw interest rates fall a lot, and we saw the Fed step in to the market in order to try to stabilize, as we saw the COVID pandemic starting to spread across the globe. So we saw interest rates go very low, almost to zero, and stay there for a long period of time. And then at the later part of the chart, you can see that the federal funds rate in red and the blue triangle start to increase, and you can see that the green area, which is the 2-year Treasury yield, follows suit, and so they all rise in tandem. And so basically what is happening here is the Fed is starting to realize that inflation is an issue, and in order to address inflation, they try to increase interest rates in order to bring down economic activity because the economy has started to overheat. So that's why, in part, we've started to see interest rates increase.
Awesome.
There we go. Well,
All right.
I'm sure most people are like, how does this impact housing and mortgage rates? So we'll get to there in these next slides, right, Hugh?
Yeah, absolutely. So typically when we hear about the mortgage market, there is talk about the 10-year Treasury yield, which is bonds from the U.S. government that are paid back over 10 years, and then the 30-year fixed mortgage market. And so what we're seeing here is the 10-year yield in the red line and the 30-year fixed mortgage rate in the blue line. And the difference between the blue and the red line is represented by the gray bars. So that's the spread between the 30-year mortgage rate and the 10-year yield. Now, as you can see in history, that spread has stayed pretty even. So you can see back in 2012, that spread was a little under 2%, and it kind of stayed in that sort of zone for a substantial period of time, really until we started to get to COVID. So basically, the point here is that there is a relationship between the 10-year and the 30-year fixed rate mortgage, and that relationship has remained pretty consistent over time. And what we've seen recently is that you've started to see the difference between those two kind of get outside of its normal trend. So you can see that these gray bars start to rise here again in early 2020. They come back down to sort of historical averages, and then they're starting to increase again. And the reason for this is because of the pace at which interest rates have started to rise. So the 2-year Treasury yield and the 10-year Treasury yield are related, where the 2-year Treasury yield is sort of seen as a risk-free or neutral rate, and the 10-year Treasury yield is sort of seen as an inflation hedge. And what we've seen is that the difference between those, the difference between those has shrunk as we've seen the Fed increase its rates pretty quickly, which we saw in the previous slide. So let me show you on the next slide the relationship between the federal funds rate and the 30-year and the 30-year fixed and the 10-year. So looking at the same data, I've just removed the gray bars and I've added in the federal funds rate, which we saw 2 slides ago. And so what I'm trying to point out here is that even though in past there's not a relationship really between this orange line and the red and the blue lines, which are again the 30-year fixed and the 10-year yield, we have started to see that relationship appear, particularly as this orange line rises really quickly, which is again the U.S. federal funds rate, which is being raised very quickly in order to try to tamp down inflation. So the basic point is here is that even though in the past the federal fund rate has not really impacted the 30-year or the 10-year yield, we have started to see that relationship emerge over the past few months, particularly because the Federal Reserve is increasing interest rates so quickly to address inflation.
Awesome.
Okay.
Well,
Do we?
I'm sure a lot. What?
Go ahead, Jonathan.
I was just saying, I can think of questions people might be asking right now. Like that's a lot of information, but what are the big takeaways? And if you're watching the news, a lot of people are thinking the 10-year Treasury yield likely hit a ceiling at 400 basis points or 4%. I think today we're recording this video on December 5th. It's around 3.6. And so if it did hit a 4% ceiling, and historically the 30-year fixed mortgage is 2% higher, then that's a strong case for why a lot of people think 7% mortgage rates are 3% higher. And historically they're 2% over the 10-year Treasury yield. And so that's why rates have kind of been improving. And a lot of people think, we're either neutral or we're improving from here unless something, unforeseen happens with the economy and, everything else that's going on.
Right. Yeah. So the thing that I would say is that, in the past, we haven't seen as much of a relationship between the federal funds rate as we are seeing right now. But as we get to sort of depending on what your assessment is, as we get to sort of the peak, if we consider right now, or we're coming to the peak of interest rates, you should start to see that there's going to be a reduction in the correlation between the 30-year and the federal funds rate, meaning that the federal funds rate could continue to rise, but we might be entering back into a period again, like we saw in the earlier part of the 2010s, where the 30-year and the federal funds rate aren't really that related. So they've been related in the near term because interest rates have increased very precipitously over the past year. But again, as mortgage rates start to peak, we start to see that relationship decrease, go back to sort of the historical averages. If that makes sense to you.
All right.
Okay, so we're looking at interest rates and really what the interest rates, at least as the Fed, from the Fed's perspective, they're trying to raise interest rates to tamp down on inflation. Now, there's two big measures of inflation that we have in the United States. The one is the PCE, or the Personal Consumption Expenditures Index, and the other is the CPI. So I have on display here both of those measures of inflation, with the PCE on the top graph and the CPI on the bottom. Now, the PCE is the preferred measure of inflation by the Fed, but the markets will look at both the PCE and the CPI as measures of inflation. The good news is that both of those measures of inflation showed a decrease in inflation in October year on year. And markets saw that very positively last week when the PCE came out, as well as comments that were made by the Fed. So the Fed is increasing interest rates in the attempt to bring down inflation. And so what this chart is showing is that at least in October, we did see a decrease in inflation, and those numbers were positive, both on the core for the PCE and the core for the CPI. So those are definitely positive signals to the market, and showing that we're starting to see inflation get under control as the Fed has increased interest rates and reduced bond purchases.
Yeah. So in summary, what we're looking at is, okay, Fed's hiking these interest rates really aggressively. The goal of the interest rate hikes is to battle inflation. We've been waiting to see this all year long, and it looks like we're finally starting to see some stuff that's finally starting to trend down as far as year over year inflation data goes. And that's what we've been looking for. So this is one of those indicators that looks like, okay, we might be getting close to that ceiling that Jonathan was talking about as far as the interest rates go.
Yep.
Awesome.
Okay, so that's a positive signal. Now, the other piece of data that I would point to is that sort of your inflation expectations, and so this is also sort of ties into a tactical point on how you address the market. Right now, I have on display the survey results from the New York Federal Reserve Bank, and they give a consumer inflation expectation survey. So the blue markers show the 1 year expectation. So what will inflation be in 1 year in history? So you can see the survey data back through 2020, and you can see that the blue squares or blue diamonds start to increase about middle of last year when inflation started to increase. Now, the important thing about this chart is that it's the red circles, which show the 3-year median forecast or expectation for inflation, and you can see that that's much more closer to 2%. So with the market or the consumers that are responding to the survey by the New York Fed, they're saying that within the next 3 years, we should see inflation back down to around 2%, which is great news from an interest rate perspective, because if inflation does indeed get back down to historical levels, then we should see lower interest rates. And so that really gives buyers at this time flexibility to perhaps pursue, if they have available, loan products like 2-1 buy downs, where they can buy down the interest rate in the first 2 years of their loan. And then if inflation expectations, like the survey is saying, pan out and we see 3% inflation, then interest rates that by the end of 2 years will be lower, and then you can refinance. So that's one of the sort of tactical ways that you can address this market.
I think that's a good data point. But explain to us, Hugh, who's looking at this? Like, how does this, obviously that's, forecasting consumers, what consumers are thinking, but how does this play into impacting anything as far as inflation, actual inflation numbers, or interest rates from the Fed, or any of that?
Well, I mean, I would say that the expectations of future economic performance do have an impact on how we're behaving today. So it's not just sort of how we feel about things, but we're sort of building our plans based on our expectations of the future. Given the fact that the market is looking at the data today and saying we're expecting inflation to be lower in the future, that's a positive sign and gives a signal that we should be able to see lower interest rates in the future.
Yeah. Okay. Awesome.
Okay, so moving on, we're just going to touch on this very quickly. The chart on the left shows the U.S. labor force participation rate, which is how many people are actually employed over the total labor pool. And you can see that that green line was up above 60% in the early 2000s, dropped to around below 63% in the middle of this last decade. And then when COVID hit, we saw labor force participation drop significantly, and it slowly started to recover over the past couple of years. The important point here is that labor force participation rate still remains below the 12-year average from 2012 to 2022, which means there's less people out in the labor pool to be hired. And so what that has done is that has kept unemployment very low. And so we did see very strong unemployment numbers come out last Friday, and we saw a negative impact on pricing because of that. So I'm showing the total U.S. unemployment rate on the right, and you can see that we had this spike during COVID when there was lockdowns, and then that has come down quite substantially, and we're at a pretty low, even compared to historical averages, a low point for unemployment. And so this is keeping the U.S. labor market tight.
And how does the Fed react to that?
Right. So what the Fed is trying to do is they are trying to, and this might sound counterintuitive, but they're trying to actually increase the unemployment rate. And the reason for this is that one of the big drivers of inflation is the price of labor. And because we have fewer laborers in the labor market, that's pushing up the price of labor. And so the Fed is trying to increase inflation to decrease the incentive for businesses to expand their activity. And one of the ways that they expand their activities is by hiring new employees, or raising the price of labor for their current employees, i.e., paying them more. So,
and as they increase their employment count, the cost of what it takes them to produce whatever their good or service is gets more expensive, and that perpetuates inflation problems.
Correct.
Okay, that makes sense.
So, the Fed is looking for unemployment to start to tick up as they increase interest rates. Now, specifically for the Houston market, on the left, I'm showing oil and gas employment over the last 20 years. And the point here is that oil and gas unemployment is super low, meaning that jobs are in high demand for the oil and gas sector. And of course, that's specifically relevant for Houston. So that's what the chart on the left is showing is U.S. oil and gas unemployment rate. Again, currently at the lowest point since 2005. And then on the right, we're showing Houston area employment data, which is basically showing that we had a massive drop in employment. You can see the pink shaded section on the chart on the right, which is the COVID-19 lockdown area. And then we've seen employment rise. So on the chart on the right-hand side, the green line is plotted against the left-hand axis, and the orange bars are plotted against the right-hand axis. So the change, the monthly change in Houston area employment is in those orange bars, and you can see that it's basically been continuous increases in employment since COVID-19. So the Houston labor market remains tight, even compared to the overall U.S. market.
Yeah, I mean, this is amazing. This shows that the labor market in Houston is stronger now than it was pre-COVID.
That's right. Yep.
But it looks like a decent amount. I mean, that's
yeah, exactly. I think this is in amazing. Millions. Yeah. So I think this is millions of jobs. So we're quite a bit higher than where we were even pre-COVID, moving from 31 to above 33. So yeah. Perfect. And then moving on to this next slide, this shows the Houston area unemployment rate. I just showed the employment numbers. This is the unemployment rate. on the left-hand side. So again, just showing what that rate is. I don't have data all the way through November for this, but the point is that unemployment has come down substantially since COVID hit, and it is on a downward trajectory specifically for the Houston area. And then the chart on the right is showing the Houston area real wages. I only have data through Q1 of 2022, but there's nothing that would suggest that this trend has increased, that Houston area wages are still growing and have grown pretty strongly since you had those lockdowns in 2020. So the Houston area labor market is strong, even relative to the overall U.S. economy. Okay.
Beautiful.
So,
well, I think a key point to make right now is, if I'm talking to a buyer right now, a lot of buyers are like, I don't want to buy a house. I'm hearing about recessions and all this stuff. And there's a strong case that this data is making, is that nationally we could have a recession, but locally or regionally in Texas and Houston, we might not feel it as much, or we might not even experience much of a recession. And so, that's a case for home values being preserved, not necessarily going down. They might even increase some. And so, like we've always been saying, if you have a buyer that's willing and able and it's the right house, even if we have an economic recession nationally, it might not really affect Houston from a local standpoint all that much.
Yeah, that's 100% true. And if you think about the large Houston area employers, and I have a slide on this later, but there's a lot of exposure in Houston to oil and gas and also healthcare. And if you think about just the wider global macroeconomic events that have been going on as regards to energy, specifically with the war in Ukraine, it doesn't seem like there's a strong reason to see oil prices falling precipitously. So that keeps Houston sort of protected in some ways versus the rest of the U.S. because of its reliance on oil and gas prices being elevated. And the same thing for healthcare, given that even in a recession, we still need healthcare. So relatively inelastic demand there. Okay, jumping real quick to Houston area housing statistics. So what I have on display here is the single family and townhouse condo unit sales since July of this year. And I have that broken down by sales price. So the larger, brighter colored stacked bars on the left are going to be the single family homes. And then you can see the legend down below the chart showing the breakdown of the different price points. And then the lighter colored stacked bars on the right, those are going to be the townhouse sales. So we have seen both townhouse condo sales and single family unit sales fall since the middle of this year. The November data is incomplete, so I don't have all of last week's data in there, but we're pretty certain that will be a decline versus October, and certainly versus where we were in the middle of the year. So we have seen sales or number of units that are moving in the market fall, and so I just wanted to highlight that, and we've seen that for both townhomes and condos and single family units. The next slide will be a similar slide. Again, what I'm showing here is the total unit sales by month for 2021 and 2022. So that's going to be the blue and orange lines. That's going to be plotted against the left-hand axis. And then the year-over-year difference. So for instance, Jan 21 versus Jan 2022, those are mapped in the gray bars, which will be on the right-hand axis. So that's the percent change from a year previous. So what you can see here, if you're tracking the orange and blue lines, in the beginning of the year, sales were a little bit higher or about even with last year, and then starting about in the middle of the year, when we start to see the Fed increase interest rates pretty substantially, you did see sales start to decline. So, for instance, in July in 2022, July had 21% less sales than July of 2021. And then, of course, November and December data aren't complete. But the point here is that, again, we have started to see a downtrend in sales because of the increasing, in part because of the increasing interest rates. But there is some good news even with that falling sales data. So,
yeah, and I would say,
hold on one second.
Go back. That
Go
story,
ahead,
I was just saying that story's twofold, right? I mean, year over year, 22, looking back at 21, you see like, wow, -19, -22 September, -28. Part of that is higher interest rates, and less buyers qualify for a mortgage, or the payments are more than they're comfortable with. But it's also, there's no inventory. Sellers are like, I'm not putting my house on the market. And so for us to have a transaction, you need inventory, you need people to put their house for sale. And so the negative change in sales transactions, not just because of higher interest rates and buyers can't qualify, or buyers don't want to buy a house. A lot of it is just there's no house for a buyer to buy, even if they are comfortable with higher interest rates. So it's kind of a twofold perspective there.
Yeah. And the one thing I was going to point out is just echoing that November, this was put together before November data was out, and December, we just started it. So it's not going to look this bad, once we get through December. But I can testify to this. This lines up almost identically with our production this year. I mean, we're cruising through the first half of the year, and it's looking awesome. And then all of a sudden, we get to July and it starts to slow down, and August, and it just kind of kept slowing down. So I think anyone that was in the business last year and then this year, I think this is going to be something that everyone resonates with.
Yeah. And to Jonathan's point, and this is what I was trying to draw out on the last slide. So I break down the data, same sort of data that we were just looking at, but I break out the townhouse versus the single family. Interesting thing here is that the townhome, the sales have not fallen nearly as much as you have seen the single family, but of course there's a lot more single family transactions than there are townhome transactions. But what I wanted to point out is that I went and pulled this data, is that in a normal market, for prices to neither be increasing or decreasing, all else being equal, you need 6 months of housing inventory. In Houston right now, even with sales going down, we only have 2.4 months of housing inventory, which still points to a tight market within Houston, and it's still keeping, even though prices have come down a little bit, we're starting to see prices soften. So, overall, tying a couple of these various strands together, we are starting to see signs that inflation is peaking. And what that indicates is that we should start to see over the next couple of years interest rates come lower. The U.S. Job market overall has not weakened yet, but specifically for Houston, we think that we're well positioned to weather a sort of a recessionary event. And so, given our exposure to sort of oil and gas, so the labor market in Houston remains strong. We think that interest rates start to come down, and so that what that points to us is that while yes, the U.S. overall might see some difficult times ahead, we in the Houston market think that we're better able to weather those events because we still have a strong labor market. And you can see that in this last slide. So what I've done here is that I've shown the largest Houston area employers that are publicly traded in the blue line. And I'm showing their stock price going back to 2019. And I'm plotting that against the S&P 500. And so what you can see is that the blue line is actually above the red line, which means that the Houston area employers that are publicly traded have outperformed the market since really the beginning of this year. So that's sort of indicating that the Houston area market is strong, our labor market is strong, but we still will get the benefit of seeing interest rates come down as we see inflation start to peak and head lower, particularly going into Q1 and Q2 of next year.
Yeah,
baby.
When I saw this was super encouraging to me, just these last few slides. And so, yeah, if you're a realtor, you're trying to figure out what's going on. Should you be encouraged? Should you be nervous about this next year? And I think this really shows you should be encouraged because Houston employers are beating the nation. So that means that employment staying strong. We're not looking at layoffs in the Houston area. It's like the companies are growing. They're relocating people to Houston. And so I think we've got a strong case that Houston is going to continue to have housing needs. And then you look at, we're currently at 2.4 months inventory. That is not a buyer's market. Like this is, of course, end of year things, you're able to start negotiating things. But I think we get into the spring, if inventory is still at 2.4 months or anywhere close to that, man, you're going to really see housing prices shoot up. We're back in crazy multiple offer territory again. And with all that, with the inflation numbers, interest rates are low. And so I think if you were here in the spring of 2022, I think spring 2023 might start to feel a little deja vu-ish. Jonathan, what do you think?
Yeah, I totally agree. I mean, this stat right here says invest in Houston. I mean, things are happening. Capital is moving here, whether it's rental properties or it's, relocations, like you just said, with all these companies. Yeah, I don't see the case for home values going negative in Houston. I can see there be a case in certain regional markets, the Seattles, the Silicon Valley, San Francisco. I mean, you're seeing all these key states that had negative outflows of people, 80,000, 200,000. I think New York City lost 180,000 people. It's like those places you might see negative home values, but when Houston is adding 80,000 jobs a year, which that's a wife, that's a husband, that's children, that means it's adding 150, 200,000 people moving to the city, and those people need a place to live, to work, to play. And that's why you see restaurants opening up in Houston still. I mean, I drive around the Galleria and I see new restaurants all the time still popping up. So things are moving in a net positive from an economic standpoint in Houston, and that means real estate's going to follow.
Yeah. I mean, I remember, a couple of years ago, Jonathan, looking at, not the data quite this, brilliantly as Hugh's laid out, but I remember us looking at it and going, man, I almost feel like if things start to go poorly for, the country, that almost is a better thing for the Houston real estate market, and so that's just something to keep in mind is that, there can be some discouraging news things out there, but the news most of the time is national news, international news, and Houston is really its own kind of micro climate from an economic standpoint and from a real estate standpoint. I think some of this information to me goes, I would not be surprised if Houston isn't one of, if not the strongest housing market in the country next year. Bold prediction, but that's what I'm seeing.
You look back at 2014, is what I tell everybody. I was like, Houston was awful in 2014. People were getting laid off. Oil dropped 120 a barrel to 37 a barrel. It was not a fun place to do life. And nationally, things were booming, like stock market, job growth, like new IPOs, like nationally, the country was doing incredible in 2014. And we were going through a rough spot in Texas. And I think the opposite is probably going to happen in the next 6 months,
Yeah. Well, this is
cool.
awesome.
We got next, Hugh.
Yeah, no, that's basically all I had to share with everybody, except for this inspirational quote to leave everybody with from Warren Buffett: "Price is what you pay, value is what you get." But we're looking forward to doing these sort of updates more often, so that you can be more informed about the market. So we appreciate you sticking with us and listening to the whole to all of our thoughts.
Awesome. Well, Hugh, thanks for the presentation. For those of y'all that tuned in and hung in there till the end, we hope that this helped, and we hope that you'll share it with your clients and other referral partners. And if you have any questions about the market moving forward, now that Hugh knows.
That's right. All right, guys. Good one. We'll see y'all next time.
Adios.
Bye now.